Welcome, everyone. Thanks for joining in. We have the wonderful Billy Winfree with F&M Bank. I've been working with Billy for over a decade. I think he is the mortgage wizard. So he's gracious enough to join us today to answer some of the questions that's been on our minds. And yeah, Billy, we appreciate you coming out.
No problem. Thanks for having me, Frank.
Yeah. One of the biggest questions, or kind of what we've gotten the most, is just love to hear from you. What changes have you seen in the lending world due to the COVID virus? Is it harder to get a loan now?
Yeah, I've been doing this almost 20 years now, and I don't think we've ever seen a time frame with more changes. In the past 30 to 45 days, it's been, virtually daily changes as far as shrinking the available pool of people who can get a mortgage due to credit score restrictions and job and income restrictions and things like that. So it's definitely, there's no way I could rattle off all the changes that we've seen, but they've been pretty immense so far, and I don't know that we're done yet. But I think the good thing about it is if we got a buyer with a good credit score and some money to put down and a job where they're still able to work and get paid, then it's still, you're still able to get a loan.
Great. And so if I heard you correctly, so if you've got your W-2, good credit score, good down payment, you're going to be just as good as you were, 6 months ago.
Yeah, I think so. We're doing a lot more checking into income and employment really, really late in the process versus what we did maybe a year ago, for example, where it may be a couple days before closing back then. I mean, it's like we're checking the day of closing and the day before closing that, you haven't lost the job or you haven't lost your income or there hasn't been a change. A lot of people have taken pay cuts that may be temporary, but, we can't use their full income if they're currently on a pay cut. So.
So you will verify not only their employment, but verify the income, make sure it hasn't changed the day of or the day before closing.
Yes, correct.
In a lot of cases. Oh, wow.
And it's always supposed to have been that way. I mean, when the borrower signs their 1003 at closing, that is supposed to be a true and an accurate reflection of their current situation. So if it wasn't true and accurate, they shouldn't sign the 1003 at closing anyway. But I think a lot of people probably don't realize that and don't understand that. So, we have to go in and verify it and make sure that's the case.
Gotcha. What about commission-based folks? What's different for those who are self-employed or commission-based small business owners in terms of lending?
It's probably become just a little more case by case for that situation. Just take yourself, for example, a real estate agent. You're still working right now. You're still able to make money. You're still able to, to sell houses and list houses versus a hairdresser, for example, who's not able to go in and cut hair as he or she normally would. So for that person, it's going to be a whole lot harder than it would be for somebody like yourself. We're getting into, is their business open? Are they operating? Are they operating at full capacity or, not at capacity? I think the hairdresser is a good example, or massage therapist. It's going to be really hard for those people right now because they're not able to work.
Gotcha. All right. Next question. When the Fed lowers the interest rates, does that mean mortgage interest rates go down?
No. The federal funds rate is an overnight lending rate that banks loan to each other. Basically, it's a loan that is no longer than a 24-hour duration. So there's obviously no correlation between a 24-hour loan and a 30-year fixed mortgage, for example. Mortgage rates are determined by mortgage-backed securities, and there's also a component in there of servicing valuations. And the servicing just means who you're making your mortgage payment to. That's your servicer. The servicer typically doesn't own the mortgage. Most of the time, that loan is being sold to Fannie Mae or Freddie Mac. It's put into a mortgage-backed security, and there's some investor out in the market that's buying this huge bond that's a mortgage-backed security, basically, that has, many, many loans inside of it. So if you make your payment to Wells Fargo, for example, they most likely they don't own that loan, and they're passing the money through to Fannie Mae, Freddie Mac, Ginnie Mae, which is government-backed, like FHA and VA loans. The rates really are set by those things. One part of the market right now that's not functioning as well as it normally has is the servicing side, because of all the issues that are going on after loans are closing, or the worry of what could go on after loans are closing, such as do I buy a house today, close on my loan, and lose my job tomorrow? So am I going to have trouble making my first payment, second payment, third payment, that kind of thing? That's a problem that a servicer doesn't really want to deal with. So you've seen, I think rates are a little bit inflated right now versus where they should be, because the servicing piece just isn't as attractive as it typically is when a mortgage company is setting the rates.
And so the servicer they've got a percentage built into the rate as well, kind of for their fee to serve.
Yes, the servicers will get paid. They make money when you make a late mortgage payment. They're getting late fees. When they're handling your escrow accounts, your taxes and insurance, and yes, they're getting a strip of maybe I don't know the exact number, but I want to say it's around 0.25% on the loan that they get. That's really how the investor pays the servicer. So it can be profitable for them, especially if it's typically the servicing side of the world is you've got to do it in pretty high scale for it to be pretty profitable. That's why you see a lot of the big banks are, kind of the lead servicers typically, because they just have the ability to do it a lot bigger than a bank like F&M Bank, for example, or small local banks.
Gotcha. So are the interest rates the same for buyers versus refinancers, people who are looking to refinance?
Our rates are the same for buyers and refinancers. There are some lenders out there that will charge higher rates for refinances because they get so busy and backed up that they just can't keep up with their purchases. So they may increase the rates on refinances to kind of help slow that down a little bit. But I think overall, most banks, most lenders are going to charge the same, because really a new loan is a new loan to the lender.
Gotcha. Okay. Thank you. All right. How much, we've gotten this question a lot. How much lower does the mortgage interest rate need to be in order for it to make sense to refinance?
That is a question that really can be a case-by-case answer. For example, if you've got a $800,000 mortgage, you may only need 0.25% to 0.5% difference in the rate. Whereas if it's a $75,000 mortgage, you might want to see a 1 to 1.5% difference in the rate. And that's really just because, the larger the loan amount, the more the interest rate affects. A smaller change in rate saves you more money on a large loan than it does on a really small loan. So that's probably the number one thing. I mean, there's other factors that are at play. For example, let's say you've got a guy who knows he's going to move in 5 years. He may need a bigger difference in the rate for it to make sense for him versus someone who knows they're going to be in this house for 20 years. So, the timeline on how long you're going to own this property also is a big factor in that.
Yeah, that makes sense. Awesome. Thanks, Billy. So we need your crystal ball. And I know you love doing this. So do you anticipate rates to stay low, go up, go down, in the next 9-12 months? What's your prediction?
Yeah, that's a tough one. You tell me what home prices are going to do, and I'll tell you what rates are going to do. No, I think obviously no one knows the answer. If they tell you that they know the answer, with more than a 50-50 shot, they're lying to you. Like we talked about a minute ago, the main factor behind what's going on with mortgage rates is what are mortgage-backed securities doing. And the people that trade those mortgage bonds or mortgage-backed securities, they're responsible for billions and billions of dollars of these every day. So if you think that, or if someone thinks that they aren't trading based on everything that they could possibly know, we're fooling ourselves. So if you or I knew, had some insight into what was going to happen with rates, I'm pretty sure the traders on Wall Street are going to know it too. We're not going to have any insight that they don't have. So they're already acting and trading on that, and it's impacting rates today, what they're doing in the markets today. So there's obviously no way to be sure on it. I do think with, everything that we've got going on right now, it's pretty likely that we're going to have low rates for the foreseeable future. Is that going to be 9 to 12 months? I don't know. I think there's a decent chance of that. But I think it's going to be really hard for us to see things do something significant, or, rates go significantly higher in the near term anyway. In the next 3 to 6 months, I would kind of put that number on it, just because for rates to go up, we really need inflation expectations to pick up, or the economy just to take off. And it just, with everything we're dealing with right now, I just don't know that that's going to happen in the next, few months.
I think you want to tell new folks when they're applying for a loan, hey, do this, don't do this.
I would tell you to be honest with your lender. If you are expecting some sort of income or job impact from COVID-19, I would go ahead and lay it out on the front end so that you can deal with it versus it popping up 2 days before closing or a week before closing. That just is a lot more stressful on everyone. The more time you have to work out a problem, the better in our world. So, if you have a suspicion that something's going to happen, or if you already know something's going to happen, I would just lay it out to your lender and try to figure out the way around it. That's what we're here for. That's what we get paid to do, is to figure out how to work through those scenarios and situations and figure out the best way to make something work.
Billy, what's the best way to get in touch with you? If they have questions about a loan or ready to get a loan, what's the best way?
I think email, honestly, is probably the best way right now. And phone, obviously would be after that. So email is billy.winfree@myfmbank.com. That's BILLY.WINFREE @MYF as in Frank, M as in Miles, bank.com.